Moving on now, and it's time for our weekly market analysis. Joining us this week is Trados commodity trader Doug Simon. This week, Doug and I discussed a multitude of topics ranging from basis to conditions in South America, but we began by discussing the current planting progress here in the U.S.
And so it's on average, like you said, they're a little faster in the Eastern Corn Belt over in Illinois, and a little slower out here where we've had some snow. I actually drove down to Memphis on the weekend, and there's some stuff going on down there, but they've had a lot of rain down that way, so they're a touch slow probably down that way. But yeah, we're early in the year. Weather next week's supposed to warm up. I think there's a lot of farmers chomping at the bit. There's a little bit of corn and beans in around here, not a lot, but more so in the Eastern Corn Belt. But yeah, it's I don't think yesterday people were asking about why the market was excited. They're not. I don't think they're excited about the corn and soybean planting pace. Maybe a little bit about the wheat side of it, but that it's right on pace there.
And Doug, I know Troy wouldn't let you get out of here without talking a little bit about basis, so what can you tell us?
Last year, basis levels were pretty warm, and probably the best thing going on right now is ADM Columbus, which is the largest ethanol plant in our state, and the other one is Blair. I mean, the ADM Columbus has come back online, and so they're buying corn, and their basis levels have improved from 18 under to 12 under 2 weeks ago, and then they came into actually 12 over on basis. So they swung about 24 cents here in the last week, which is good to see. It's good for the local market. When you look at ethanol margins, look at Iowa State's ethanol calculator. I mean, average over cost is about 24 cents, and the year prior to the pandemic it was about 9 cents positive. So that the ethanol margins have improved in here, and that's probably allowed that ethanol plant up at Columbus to restart. And there's also some ethanol shipments that occurred 3 weeks ago. They had ethanol going to China, which is good. So we've got a very hot export market. So we've got rail loaders here in the state competing with the ethanol plants, and that's given us a very firm basis. And the nice thing too, also, the futures market's inverted by 16 cents. The May board is 16 cents over the July board. So when you look at that deferred delivery, the cash bids had actually been lower. They're trying to encourage people to deliver corn sooner than later. And now at least we're seeing some, maybe a touch of carry in some of the markets where I think everybody's concerned about getting enough corn delivered, not only just April, May while people are planting, but also into that June, July. People don't want to let any corn get away for that 4-month period. So that's encouraging from a farmer's perspective.
And you mentioned grain prices continue to do well. A lot of folks are wondering just how much higher can these markets go? Any thought on that?
It's really, when you look at it, last time I was on here, I talked about weather in South America, the second crop that they raised in Brazil, in Mato Grosso do Sul, and those areas in that kind of main second crop, the safrinha crop, it's been dry. And now we're in their kind of June, July timeframe. So it's really critical that they get moisture. And they go from a rainy season into a dry season. So the corn crop got started late because it was a little wet early. Now it's dry, and it's concerning because they've got projected about 109 million metric ton crop. And if you lose 10% of that crop, that's 10 million metric tons, or equivalent of about 400 million bushels. And our exports from the US then are going to pick up and be able to compensate for that lost export capacity that they had, which is why we're pushing this market higher. It's also going to give us more export opportunity out late into the summer, but it's also going to draw down our old crop stocks, which are projected to be somewhere 1.3 billion. Maybe you're down closer to a billion. That's the kind of math that people are running through their heads the last several days. So how much higher can it go? I mean, that's a good question, but right now, a little bit relaxed overnight, from where it started out this morning. Prices are off a little bit, but there's going to be ups and downs, but it's still going to be a rush between these importers, the trains that they're trying to fill, and these ethanol plants, because the margins are all good. So it's positive for the farmer right now.
Yeah, before we let you go today, Doug, do you have any marketing or risk management advice you'd like to share with our viewers today?
As a risk manager, we're always looking ahead in terms of trying to protect our corn and soybean crops. And farmers look at those break evens right now. If you've got 530 D's corn and you've got beans that breached, the $13 level overnight, those are highly profitable. So we're asking ourselves, if we look at selling incrementally over a season, seasonal time frame, and we're into April already, we want to make some sales in February and March and April, and on the corn, and the beans were kind of getting into a point here where we want to be doing some things. But we've been using options this year more just to have some flexibility upside because of these tight balance sheets. And it'd be different if we were going to resolve our tight carryouts here soon, but we want to have that flexibility. So if we're hedging, we're buying some out of the money calls to go with it. And if we're, on the soybean side of it, again, hedging, buying some calls or using some puts. And if you go all the way out to November or December, those puts, there's a lot of time value in them. So there's a lot of premium that you're paying. We're using short dated options to put a floor underneath it, allow us to trade into a higher market, stuff that we did puts for before that report on March 30th. The market's rallied 80 cents. So you give up a dime and a put and pick up 80 cents. That's a good trade-off in my opinion. In a market that it's going to be very dynamic this summer. You don't know where it's going to go. So trying to sit here and predict what it's going to do, you can't do that today. So you have to think about, okay, how am I going to manage risk? I know basis is going to be firmer into the summer for both corn and beans and new crop levels. So I don't want to do any cash sales. I'll use futures, use the futures options market, just because I think those basis levels at harvest delivery are going to be firm again. And I think during next year, the marketing year, there's a lot of analogs to 2010, 11, and 12, if you go back and you look at the history right now. And so those basis levels in those years were very, very strong and gave us great opportunities to improve the futures prices that we were selling through there. So it was very, very dynamic. And I'm old enough now, I've kind of been around in some of those other markets. So I remember not exactly what happened in 2010, 11, and 12, but we've got a lot of, kind of scars from those years. I know what happened and can anticipate what's going to maybe show up here in the next couple of years.